Hello, welcome to our webinar series of Strategic Level 1, and I must appreciate the efforts or the initiatives taken by CS Sri Lanka in organizing this webinar series for SL1 students. This is and I am under the impression that this is of an immense use for the students who will be sitting for the exam in coming June, hopefully in July. And my name is Chandana Jagatkumara. I will be taking the financial reporting part of it, which is 55% of the syllabus weightage, and the balance 45% will be taken by Mr. Suranga Indonil, one of the most leading lecturer, one of the best lecturer for auditing. And this is how it will be. I will be covering about 20 hours of lecturing for financial reporting part, and proportionately is equivalent number of hours will be allocated for auditing part as well. Now, I will not discuss the paper structure, the syllabus contents, and you all know it by now. And let me start with a very important topic today, and this has been of an immense importance from the examiner's viewpoint, and so many questions have been set from this area. And sometimes the performances are reported to have been very poor because the students lack the technical knowledge of the standard. This is LKAS 12 taxation. Normally 2 hours are allocated for a topic, but I will not be able to finish this topic just within 2 hours. It is so heavy and bulky, and also I just thought of giving its prominence deserving attention because the questions given from LKAS 12 have been so deep and I can't say complicated, but hard. As a result, I will take you through each and every single element, each and every single area, each and every single nooks and corners of the standard, so that you can score the marks to the fullest extent possible at the exam. And as you all know, covering this topic in 2 hours time is quite challenging. I will not do that. I will take at least 4 hours to complete this part, because I want you to drink this cup of standard right down to dreg without just sipping the bubbles floating on the surface. If not, you will not be able to answer the questions that the examiner sets at the exam. I want you to keep the standard book as well close to you, and whenever needed, whenever required, you can refer to the standard book as well. I will be referring to some definitions, and I will be referring to some paragraphs in the standard book, so you can see then and there without it being a hassle. Alright. Now, first and foremost, before I start embarking on the technical matters, the discussion of the technical areas of the standard, first and foremost, let me explain where the standard will be important and why it is important, why this is considered to be of such an important, why this is considered to be such an important standard in our syllabus. Let me explain. Now, let me assume that I am just a businessman, smarter businessman. I started my business from scratch sometimes back, and I am quite, new to financial accounting, taxations, my understanding about taxation, my understanding about financial accounting is absolutely low, and as a result, just for the purpose of looking after the tax matters and finance matters, I just thought of hiring an accountant who was a lady. Right at the beginning, from the day when I started my business, I hired an accountant as well, and I have to look after my business matters. I will look after my babies, I have left all my accounting matters and tax matters on the delicate hands of my accountant, who was a lady, and let her look after her babies, I will look after my babies. Now quickly, time flies quickly. 4 years have gone. For every year, my accountant had prepared the financial statements and they were presented to me. For the first year, there was a profit. There was a profit of 5 million rupees. 5 million rupees. And for the second year as well, the financial statements had been prepared. The profit shown by the second year financial statements were 7,500,000. And that continued, that proceeded to the third year as well. The profit for the third year was 8 million rupees. We are now in the fourth year, just ended. The profit for the fourth year was 9 million rupees, 9 million profit for the fourth year. Since I am absolutely clueless about financial accounting, since I am absolutely clueless about taxation, I did not have any understanding to raise any questions from my accounting as to how the profits were calculated, where the tax figures were, whether the tax figures were deducted already from the profit, or whether we are supposed to pay taxes. I have only heard of taxations and never done anything, any damn thing about taxations ever in my life. Then I can remember simultaneously, as I started my business, I hired an accountant to look after my finance matters and tax matters. At the same time, I had purchased some assets, we will call them property, plant and equipment, of 4 million rupees. 4 million rupees. Still I have not started discussing and explaining the standard. I am still explaining where this LKAS 12 plays a significant role and why it is considered to be such an important standard in our financial reporting. Assets were 4 million rupees. One fine day, 4 years back, I can remember my accountant telling me that she is going to depreciate the assets by 25% for a year. In other words, she is going to depreciate this assets value of 4 million rupees over 4 years time. And you all guys know the profit figure given for each of these 4 years at a stretch are obviously after the depreciations been deducted, and these profit figures are after accounting depreciation. Until the fourth year end, my accountant, though she has been smarter in tax calculations and accounting calculations, she never educated me on tax matters. She did not even tell me that we are supposed to pay taxes, and all of a sudden we were in a problem because we got a letter in red color from Inland Revenue Department saying that ever since we started business, though our business is tax liable, we have not been paying taxes over 4 years time ever since we started the business. And that was pretty annoying. I just felt that the accountant who was supposed to look after and attend to the tax matters has not been attending to the tax matters as I expected, and I felt that she has been little negligent, like whatever it is, now we need to complete our tax matters to do the tax payments as required by the law, and we can't violate the existing law in the country, being responsible citizens. So then we became little busy of attending to the tax matters, and then we are finalizing the first year tax matters. And let me show you how the first year tax calculations were done, and you need to remember these figures. And since you all are the strategic level, these are just tiny and small things. As you pay taxes, the profit on which the tax calculations are determined or tax calculations are done are not the accounting profit, are not the profit that is shown in the accounting profit and loss, are not the profit which you call the accounting profit in our jargon. And for the purpose of determining the tax obligations, you need to perform another calculations which we normally call the taxable profit. Hardly can we find the accounting profit being equal to taxable profit and vice versa. Why? Because you ever do this accounting profit calculations based on the requirements of SLFRS, whereas you calculate the taxable profit based on the requirements of existing tax law in that particular tax jurisdiction. So, as a result, accounting profit can be one figure and the taxable profit can be another figure. Accounting profit mathematically is hardly equal to the taxable profit mathematically, and these figures, two figures, will be two different figures sometimes. Why? We will explain the reasons in a little while. I am still explaining why this LKAS 12 can be considered to be such an important standard in financial reporting. Now, my accountant, the way she did the calculation, she started calculating the taxable profit. First year, this is where she started from. She took the accounting profit. Accounting profit is 5 million. Now, in our accounting practice, in our accounting jargon, the value of the asset of 4 million rupees is deducted from your accounting profit over 4 years time by 1 million rupees each. So, we used to call them depreciation. Tax people have a different language, different culture, different jargon, different parlance, but the concept will be, at the end of the day, will be the same. They never call it depreciation. They have a different language. They call it capital allowances, where the rate of capital allowances will not be similar to the depreciation rate in our financial accounting. The period during which the assets are recognized as expenses to the profit and loss in financial accounting will not be consistent and equivalent to the period during which tax people deduct it as a deductible expenditure from the taxable profit, and there can be multiple number of differences between the accounting profit calculations and the taxable profit calculations, and not that are we going to discuss the taxable profit calculations. Here we will discuss how taxations are accounted. Let me just leave it aside for the moment and let me concentrate what I started to discuss and explain now. So then, since the accounting profit of 5 million rupees for the first year is already deducted by accounting depreciation of 1 million rupees, which is not tolerated, accepted by tax authorities, what they simply do is, this accounting depreciation will be added back just to make it look as if we have not deducted accounting depreciation. In other words, your profit figure, if not for depreciation, would have been how much? 6 million rupees. Why? Because our depreciation in financial accounting will be absolutely different from the depreciations in taxation. We call it depreciations, they call it capital allowances. Now, the profit figure without accounting depreciation is 6 million. Tax people, based on the existing tax law, say that the same assets should be depreciated for tax purposes by 50%. That, in other words, the value of the assets of 4 million should be deducted from the taxable profit only over 2 years' time, whereas we used to deduct the same value of assets from the accounting profit as expenses over 4 years' time. Now I will deduct tax depreciation or capital allowances of 2 million rupees. So my taxable profit becomes 4 million rupees. Come on, this is quite surprising. I was taken aback with shock. Why? We are living in a country like Sri Lanka, where I cannot ever believe that my accounting profit is bigger and the profit on which I am supposed to pay taxes is quite low. I thought my accountant, she was Sulochana, would have made some mistakes and blunders in doing these calculations. I wanted her to go through the same calculations from the beginning to the end, to the beginning, from the middle to both ends, to make sure no calculations errors were there. And she was pretty clear that all the calculations were absolutely correct and perfect. Then I was so happy. I was at the top of the world. Why? I am just thinking, I was to pay taxes on my accounting profit of 5 million rupees, but my accountant is asking me to pay taxes on just a small profit of 4 million rupees. There is nothing, there is no any other greater pleasure in life than you having to pay a small amount of taxes. The smaller the taxes you pay to the government, the bigger the savings right within your business. Just imagine a small tax rate like 20%, and my tax payment to the first year should be 800,000. Let me bring it to profit and loss. Bring it to profit and loss. And profit after tax for the first year should be 4,200,000. 4,200,000. Since I am a businessman who is absolutely clueless about taxation, I can't still believe this. I was under the impression that I was to pay taxes on 5 million. Come on. To the most of my surprise, my accountant consulted me to pay tax only on 4 million rupees. So let it to continue. Sometimes we are so pessimistic and we are supposed to be so optimistic. Now I am going to be so optimistic about the existing tax law in the country. I am like now favoring to the existing tax law because it is going to favor to the business community for having to pay a small amount of taxes. Let me continue with the second year now. We will complete the second year tax calculation. Still, my accountant started with the accounting profit of 5 million. Great. This is still after the deduction of accounting depreciation, and it is added back to make it look as if accounting depreciation is not deducted. What if you had not deducted accounting depreciation? Your profit would have been 6 million rupees. Now, accounting depreciation, which the tax people, tax authorities do not tolerate, is added back, and now we are deducting tax depreciation or capital allowances rather and now even for the second year, taxable profit, the profit on which I am supposed to pay taxes becomes 4 million rupees. I am thinking for myself. I am thinking for myself how lucky I am for having to pay tax on such a small profit of 4 million, whereas I was thinking to pay taxes on my accounting profit of 5 million. I have felt that the accountant whom I recruited at the beginning is the best accountant ever in the world. Why? She is saving so much within the business. I just thought of taking her to Singapore and to give her massive salary increment into the second. Now, without waiting further, what need to be done should be done immediately. We paid taxes for the second year as well, and my profit after tax for the second year became 6,700,000. 6,700,000. Right. Things were okay. Now we can move on to the third year. Third year, accounting profit is 8 million, and you know the procedure now. Accounting depreciation has already been deducted from this profit calculations. I will add it back. If not for accounting depreciations, what would have been my profit? That would have been 9 million rupees. Now we have a small problem. The problem does not seem to be small. How much did I say the asset value were at the beginning? 4 million rupees. I deducted 2 million from the first year's taxable profit years. I deducted another 2 million from the second year taxable profit. As you all know, you are smarter. As you all know, can I deduct another 2 million from my third year taxable profit? No, nonsense. And the maximum amount that you can ever deduct from the taxable profit should be limited to 4 million rupees. That is what you can deduct up to, and nothing can be deducted beyond the 4 million rupees. So I have deducted everything which I could deserve to deduct. So now from the third year profit, I cannot deduct anything. So my taxable profit becomes how much now? 9 million rupees. Now, the luck doesn't knock at your door always. So there are ups and downs in life. There were tax savings during the first 2 years, so it's going to be the other way now in the third year. The profit on which I am supposed to pay taxes in the third year becomes how much? 9 million rupees into 20%, that becomes 1.8 million rupees. Come on, I am starting to think as to what has happened in the third year by keeping my hands on my head and by pulling my hair to all the possible directions. I am still thinking without being able to realize what the hell it has happened. Why? Because I was thinking to pay a little amount of taxes and to wash my hands in the third year as well, but now in the third year it has been the other way. My taxable profit is pretty higher than my accounting profit. What to do? This is life. 1.8 million you need to pay. You need to pay. I paid it immediately, deducted it from my accounting profit in the profit and loss. So what should be my profit after tax for the third year? 6,200,000. Now I am looking forward to pay a little and a small amount of taxes in the fourth year. Let us see whether my expectations will be materialized in the fourth year. Accounting profit in the fourth year is 9 million. This is already after accounting depreciations of 1 million. We will add it back. Add it back. Now in the fourth year again, can we deduct 2 million capital allowances once again in the fourth year? No. All what you could deduct relating to this asset being concerned have been deducted right during the first 2 years, so nothing left to be deducted in the third and the fourth year. So my taxable profit becomes 10 million rupees now in the fourth year. Into 20%, my tax payment to the fourth year becomes 2 million. Let me bring it to profit and loss and we will pay it and finish it off. My profit figure after taxation now in the fourth year is also 7 million rupees. 7 million, right. And this part cannot be a hassle for anyone at the strategic level. And if any one of you did not get what I did here, you do not deserve to be at the strategic level, remember. Now let me explain the concepts. You know, financial statements are supposed to have certain qualities and characteristics. There should be timeliness, there should be understandable, there should be verifiability and so on and so forth. Lot of qualities and characteristics are supposed to be there in the financial statements. We prepare the financial statements not just aiming only the shareholders, and it is by and large for all the stakeholders. The language you talk in the financial statement should be understandable to all the stakeholders. You need to make it as understandable as possible to all the stakeholders. Now, I am a businessman whose accounting background can be the poorest ever in the world. I do not understand any of your accounting jargon. I am just a smart businessman. One day, when there are setbacks, you need to sit back and think. You need to see what the problems are. You need to identify the problem and you need to think of the solutions. Now, I am really sick of running the businesses in Sri Lanka because this tax pattern, tax payment pattern is hell of a hassle for me. I do not understand why sometimes the tax figures become so small and sometimes the tax figures become so big. I really do not understand this philosophy and the jargon and the logic. I want to sell my business. Even if I want to sell my business, I need to find someone who will buy my business. I should explain my performances. These are the profits. These are the profits. Here, tax figure, taxation, first year 800,000. Just imagine someone not like you, whose accounting background is as poor as mine, just have a glance at my profit and loss and he will be totally confused. Why? The profit figure is 5 million, existing tax rate is 20%, and this man is thinking, how come the tax figure becomes 800,000 rupees when the profit figure is 500,000? Because everybody does not know the fact that we are paying taxes on a different profit called taxable profit, and most of the business people might think that we are paying taxes on our accounting profit, and that is their general understanding. Now, this businessman who is like me keeps thinking, how come your tax figure becomes 800,000 when the profit is 5 million rupees? In other words, your items of income in the profit and loss and all the other items of expenses will be correlated. Higher the sales figure, the higher the cost of sales figure. The lower the sales figure, the lower the cost of sales figure. The higher the revenue, the higher the administrative expenses. The lower the revenue, the lower the administrative expenses. So, there is a pattern and a rhythm in which the revenue and the expenses behave. There is a style. but there is no style here. Profit figure 5 million, tax figure is 800. This is not correlated, this is not aligned to each other, this is not consistent to each other. So, the profit figure and the tax figure not being consistent to each other will complicate and will confuse most of the readers of the financial statements to understand. So, this quality of understandability disappears like the mist before the sun, that disappears. So, for the purpose of catering to all the information requirements of all the stakeholders of financial statements, me being a businessman will think of something intellectually. How can I correlate my profit figure to my tax figure? How can I correlate my tax figure to my accounting profit figure? I want my tax figure to be equal to 20%, not on this different tax figure, but on my accounting profit figure. So, that is my requirement. I want my tax figure to be equal to 20% of my accounting profit, not on this different profit figure of taxation. Why? What I am reporting to my stakeholders is not the taxable profit, but my accounting profit. Then, I just thought of paying taxes on my accounting profit. What if you paid taxes on your accounting profit figure 5 million, tax rate is 20%, your tax figure would have been 1 million rupees. Next day morning, if I rush off to Inland Revenue Department with the balance amount of 200,000 rupees and ask them to accept the balance amount of 200,000, will you ever think that they will accept? No, they will not accept. Even if I start rolling on the ground by keeping a bottle of poisons between my lips, threatening them to accept the balance amount of 200,000, will you ever think that they will accept the balance amount of 200,000? No. Then what I will do is, for good or for bad, I am debiting 200,000 rupees to the first year profit and loss. I cannot credit to cash, this is debited to profit and loss, I cannot credit to cash because the Inland Revenue Department tax authorities never accept the 200,000. Instead, what I did was, I opened up a small T account in my ledger. Let us see what this account is in a little while, we will give it a name later. And this 200,000 was credited to this special account opened up in the ledger. There is a credit balance that will be taken to the next year. Second year beginning, the balance is 200,000. Now, profit after tax in the first year is no longer 4.2 million rupees. Profit after tax in the first year becomes 4 million rupees. Now only I am satisfied, now only I can have a relieving breath. Even nowadays breathing is so hard and even breathing is a challenge these days. I have correlated my accounting profit to the tax figure. In other words, I have made look that my tax figure is just 20% not on the taxable profit but on the accounting profit. Anyone, irrespective of whether they are from the accounting background or not, will simply understand profit is 5 million, existing tax rate is 20%, tax figure has to be 1 million, profit after tax is 4 million rupees. So, life is not so hard now, life is very easy, life is very comfortable, understanding is very comfortable, very simple, and this is what I ever wanted, right. Second year, what if I paid taxes on my accounting profit? Would have been 1.5 million. I want my tax figure even in the second year to be equal to 20% of my accounting profit, not on a different profit called taxable profit. However much I try to make the tax authorities accept the balance amount of how much, 700,000, they won't accept. How does that 700,000 come? 20% of 7.5 million will be 1.5. I paid only 800,000. I prefer to pay the balance 700,000. They won't accept. I will debit that 700,000 to profit and loss in the second year, and let me credit that to the special account in the ledger, 700,000, so that we have a cumulative balance of 900,000 in this account. Let's see what this account is later, so don't panic. And the balance at the beginning of the third year is now how much? 900,000. Every action has a reaction. If you have ups, later there can be downs. If you have downs, and there can be ups later in life. Third year, what is my accounting profit? 8 million. So what was my tax figure? 1.8 million. And I wanted ever my tax figure to be equal to 20% of my accounting profit, not on a different taxable profit. What if you paid taxes on your accounting profit? That would have been 1.6 million rupees. How much have you paid already? 1.8 million rupees. Now, just because you want, you can't just pay 1.6 million rupees and wash your hands. Why? Tax people collect the taxes. Tax authorities collect the taxes based on the tax law, which is 1.8 million rupees. I can't have a different opinion. Now, for me to make it look as if I paid taxes only on my accounting profit, my tax figure should be made to 1.6 million rupees. And to reduce it down from 1.8 million rupees to 1.6 million rupees, I need to credit to profit and loss by 200,000 against 1.8 million rupees. And I credit profit and loss by 200,000, debit to the special account by 200,000 rupees. Now even in the third year, yeah, this has to be corrected. I mean, the second year, it was before here 6.7 million. Now it's going to be 6 million profit after tax. Here it was 6.2 million rupees, now it is 6.4 million rupees. Very simple understanding. Accounting profit before tax is 8 million rupees, and taxes are like 1.6 million rupees. Deduct it, and then your profit after tax is 6.4 million. It's like you paying taxes. It's like you having paid taxes not on the taxable profit but on the accounting profit. Last year, you know the procedures and protocols now, it's not so hard. My taxation for the fourth year would have been 1.8 million rupees. How much have you already paid? 2 million. For me to make my tax in the fourth year look equal to 20% of my accounting profit, I need to credit 200,000 rupees against, is it 200,000? Yes, 200,000 rupees. I have made a mistake here. It has to be 7.5 million, and this has to be 7.5, this is 6.5 million. 6.5 million rupees into 20% is 1.3 million. 1.3 million. 1.3, it has to be 500,000. Tax figure should be 1.3 million. It has to be here 200,000, and please do the correction here, please. It has to be 400,000. Should be 400,000, and end of the third year the balancing figure in the special account should be 200,000, sorry, it has to be 200,000. And let me complete quickly the fourth year. Now, I need to credit another 200,000 rupees against 2 million tax figure to make it look as if we have paid taxes on the accounting profit. You credited profit and loss by 200,000 rupees and debited the special account by 200,000, so that the special account has a zero balance end of the fourth year. Now, the profit after tax figure end of the fourth year, for the fourth year profit after tax figure becomes how much? This is 7.2 million rupees, 7.2 million rupees. And this is what we are going to discuss in detail throughout our discussions of LKAS 12. Now, you have seen two tax figures in the profit and loss, two tax figures in profit and loss. Here in the first year, we recognized 800,000 tax figure, and besides that 800,000, we also recognized another 200,000 tax figure. What are these two taxes? And that is what we are going to discuss in detail. Here, this is what you need to understand. Our accounting profit calculations will be always based on the IFRS or SLFRS requirements, whereas your tax profit calculations will be based on the prevailing tax law or tax jurisdiction. Hardly do these two figures of accounting profit and tax figures become equal, and since you pay tax on a different tax profit which is not consistent to the taxes on accounting profit, some adjustments may be required to be incorporated in the profit and loss in the financial statements. So, there are two tax figures to be recognized in the profit and loss. What are these two tax figures? First was the taxes actually paid or payable based on your taxable profit. Second figure was what? The second figure of taxes was an adjustment that was needed to make your tax figure equal to the tax obligations on your accounting profit. So, there are two elements of taxes that we need to discuss in detail. First is the tax paid or payable based on the taxable profit. Second is the adjustment that is needed to make your tax figure look consistent or equivalent to the accounting profit. So, that is what we are going to discuss in detail through and through, and I hope this part was clear, and you need to get this part right for us to go forward. Now, the standard does not devote so much of prominence for the first part. We call it current tax. What is current tax? And we have been given the technical definitions in the standard. The taxes that are determined based on taxable profit. I can take you to the definitions in the standard taxable profit. taxable profit, or rather current taxes, please, I made a mistake, current taxes. Let us look at the technical definition. Current tax is the amount of income taxes payable or recoverable in respect of the taxable profit for a period. Current taxes are the amount of income taxes payable or receivable in respect of the taxable profit. So, these figures were the current taxes. This is the amount of taxes paid based on the taxable profit in the first year. This is the amount of taxes paid in respect of the taxable profit in the second year, and these were the taxes paid based on the taxable profits in the third year and the fourth year. They are called current taxes as per LKAS 12, current taxes. I hope it was clear. And the second one, every year, other than the current tax, we had another element of tax figure in the profit and loss, and that is called deferred taxes. Not that I am explaining deferred taxes right now, no. Deferred taxes, what are those? We have been given the definition. Deferred taxes are the taxes that arise on the difference between the accounting profit and the taxable profit. Deferred taxes are the taxes that arise on the differences between the accounting profit and the taxable profit. Now, let me show that in the second year, your accounting profit was 7.5 million, and what was your taxable profit? 6.5. And the difference between the accounting profit and the taxable profit was 1 million. 1 million difference into 20% was 200,000, and that is what I have taken here, other than the current tax figure in the second year, 200,000. So, remember, for us to become mastery of LKAS 12, we need to equally learn two aspects of taxation. You need to know what current taxes are and what deferred taxes are. Also, you need to learn how the accounting should be done for current taxes as well as for deferred taxes, and then only we can be happy that we know LKAS 12 right in full. Right. Now, let me take you to the second step. Now, what requires deferred tax calculations to be done, or what requires deferred taxes to be recognized, is the simple fact of the accounting profit being different from the taxable profit. Differences between the accounting profit and the taxable profits. We will talk about current tax in detail in a little while, and we need to pay more attention on deferred tax part, and that is where most of the complications are. Differences between the accounting profit and the taxable profits are basically taken into two categories. Some of the differences are temporary differences, and some of the differences are permanent differences. And for the God's sake, remember, I will explain the philosophy and the rationale behind it in a little while. We calculate deferred taxes only on temporary differences between the accounting profit and the taxable profits. Just for the time being, remember, we do not recognize deferred taxes on permanent differences. So, I think I have to explain first what these temporary differences are and what permanent differences are, and that understanding is absolutely important in going forward with the balance part of LKAS 12. Now, say I am in 2009, this is my current year. I have completed doing my accounting profit calculations for the moment. Accounting profit has been defined in LKAS 12. Just remember for the moment, the accounting profit is the profit that appears in the profit and loss. That is not the technical definition. So, let us look at it in a little while. Accounting profit is 5 million rupees, 5 million. On 1st January 19, I had placed 10 million rupees in a fixed deposit at 10% interest rate, and by 31st December 19 I was supposed to receive 1 million interest income, which I did not still collect in cash. Now, on accrued basis, you recognize the receivable by debiting to receivable account and crediting to income. Interest income for 19 should be 1 million. So, my accounting profit becomes 6 million rupees right together with this interest income recognized on accrued basis. So, that part must be clear. Having completed my accounting profit, so this has to be the accounting profit now. Accounting profit should be the profit before deducting taxes. That is the technical definitions for accounting profit. Now, as I pay taxes, I need to complete the taxable profit calculation. So, then they will take accounting profit, this is where they start from, and as per the tax law, an entity becomes liable to pay taxes on interest income only if you collected that in cash. In other words, you become liable to pay taxes on interest income only on cash basis. Included in this 6 million accounting profit is an interest income for a value of 1 million rupees, which we haven't still collected in cash. So, now does it say that you should pay taxes on entire 6 million rupees? Not at all. What should be the profit on which you become liable to pay taxes? To arrive at, this is my accounting profit, to arrive at the profit on which I become liable to pay taxes, I need to take this 1 million rupees off, and that is how much now? 5 million rupees, 5 million rupees. Then this is the taxable profit, and the tax rate say 20%, and the payment of taxes for the current year should be 1 million rupees. And which tax did I say we should call this? We call this current taxes. What are current taxes? Taxes that are payable or receivable on taxable profit should be the current tax. Now, let me also show you the profit and loss for the current year 2019. Profit before tax 6 million rupees minus taxation 1 million rupees. Now, I need to do that cross check. What is the cross check? I want my tax figure to be equal to 20% of my accounting profit. What is the tax rate? 20%. What is my accounting profit before taxes? 6 million. And what if you pay taxes on your accounting profit? That would have been 1.2 million rupees. I want my tax figure to be equal to 20% of my accounting profit. For you to do that, you need to bring another 200,000. What tax do we call this 200,000? It is not current taxes, we call it deferred taxes. Now, how did you take this deferred taxes? This is how you take it. Take the accounting profit is 6 million rupees, and take the taxable profit 5 million, take the difference is 1 million into 20%, so that is how 200,000 was taken. Simply, for once and for all, you can remember, current taxes are the taxes that are payable or receivable on taxable profit. Deferred taxes are the taxes that are calculated on the differences between the accounting profit and the taxable profit. The total tax figure for the current year becomes 1.2 million rupees. It is as if you have paid taxes not on this taxable profit but on the accounting profit. Now, that is not what I wanted you to understand. I am going to explain that difference of 1 million rupees, whether it has to be a temporary difference or a permanent difference. Right. Now 2019 was done, we paid taxes, we prepared profit and losses, and the financial statements were done and dusted, completed. I am now moving on to the next year, 2020. Right. Even for 2020, my profit figure is 5 million rupees. Just imagine, assume the deposit of 10 million on which I was supposed to receive 1 million rupee interest is no more there in my business. I had uplifted deposits and withdrawn my money. So, I do not have to receive any interest for the year of 2020. Interest income has to be 0. So, my accounting profit is concluded at 5 million rupees. Now, we will go to complete the taxable profit. Where do we start from? You start from the accounting profit, which is 5 million rupees. 5 million rupees. You know, the interest income which I was supposed to receive during the last year 2019 was never received right during 2019 for some reason. But I received that in 2020. Now remember, as per the tax law in the country, tax jurisdictions, you become liable to pay taxes on interest income only when you collect that in cash. So, you did not receive that in cash in 19, so you never became liable to pay taxes on interest income. In 2020, you are receiving that in cash. Now, 2020 is the year during which you become liable to pay taxes on 1 million interest income. So, tax authorities will include interest income of 1 million rupees, not to 2019, that is to 2020. So, the taxable profit becomes how much? 6 million rupees into 20%, that becomes how much? 1,200,000. You realized in 2019 that the accounting profit for 19 was 6 million rupees and the taxable profit was 5 million rupees. Those two figures were made different from each other by the interest income recognized into profit and loss, but not recognized to taxable profit. The simple difference between the accounting profit and the taxable profit in the year of 19 was not anything else but due to interest income. Interest income was recognized to accounting profit in 2019, but not recognized to accounting profit, rather not recognized to taxable profit in 2019. The interest income that was recognized to accounting profit in 2019 was recognized to taxable profit in 2020. So, as a result, the interest income which made accounting profit in 2019 look different from taxable profit no longer remains as a difference between the accounting profit and the taxable profit in 2020. Why? It gets added back to the taxable profit in 2020. As a result, if you merge 2019 and 2020 together into a single period, then your accounting profit and the taxable profit should be a single figure, should be equal to each other. Now, 19 accounting profit 6 million, taxable profit 5 million. 2020 accounting profit 5 million, taxable profit 6 million. We'll combine them together into a single period. Then accounting profit together should be 11 million, taxable profit together also should be 11 million. See, individually there are differences, but if you merge them together into a single period, that is not a difference at all. Why? The difference that arises in 2019 is reversing in 2020. Say, for a small example, when I was in grade 9, about 10-15 years back, say I had 95 marks for mathematics and my best friend Sulochana had 100 marks for mathematics. And in the next year, I scored 100 marks for mathematics and I made her score just 95 marks for mathematics. See, individually this year we are different from each other by 9 marks, so should be the next year. But now if you combine these 2 years together into a single period, both of us have taken 195 marks for the subjects of mathematics. So, the difference that arises between the accounting profit and the taxable profit in 1 year is reversing in one of the subsequent years. So, that particular difference has to be in this category of temporary differences, temporary, right. I hope it was clear. Let me move on to the second category, permanent differences. Now, let me get back to 2019. Profit before tax, and this is the accounting profit, 6 million rupees. Now, as you did this profit calculation, we had already deducted 1 million rupees a donation given to a pauper, a poor guy, poor fellow. And since I am not that conversant and knowledgeable in taxations, I was like a philanthropist, number one philanthropist. I was so generous enough to donate 1 million rupees to a pauper, an innocent guy. And I went to the department with my profit and loss. They just glanced through my profit and loss and they just noticed this 1 million rupee donations and they wanted me to explain. I don't know for what reasons, later only I understood what it was, and they wanted me to explain that 1 million donations. I rose from my seat, I started dramatizing this story in front of my tax assessors. And what was it? One fine day when I was in my office early in the morning, a big mate man looking like a giant, broad shoulders, long hands are hanging down to the ground, all of a sudden came and sat in front of me even without the permissions being taken. And this man looks educated, but he does not seem to have had a bath for the last 10-15 years, looking so dirt, unpleasant, and he smells bad. And all of a sudden early in the morning I was quite flabbergasted without being able to think what the hell is going to happen early in the morning in my office. And this man greeted me, he said good morning, so did I. And he started conversing with me in English. He said, I am so and so, I am a chartered accountant, come on, a chartered accountant like this. And he was in torn rags, not proper clothes, not in an official attire and a costume. He was wearing some unpleasant and torn dirty clothes. And he had a beard overgrown all over the face, even the nose could be hardly seen. He said, I am a chartered accountant, okay, and I had a very fantastic family life, okay, fine. We started our pilgrimage one fine day, 2004, long time ago, 26 December, come on, from Colombo, and we stopped at Gaul Lighthouse Hotel for our breakfast, fine. And soon after our breakfast, we resumed our journey, and all of a sudden, we got caught to tsunami. I managed to escape, and this man stopped. And then the tears were rolling down on her face, and he could hardly talk. Eyes were filled with tears. I could see myself reflected through the tears in his eyes, and he could not continue to explain the balance part, and after some times he continued. And I lost my family, my kids, my wife, and I started suffering some psychological imbalanceness thereafter, for which I have been receiving treatment for the last 15-16 years. I have recovered now, so I want to start my life afresh. Since wife is dead, I thought he wanted me to find him another wife. He said, no, please don't try to punish the same person, don't try to punish twice for the same mistake. I want to start my life afresh. I want to build up a small house. And that is what we paid him 1 million rupees for. That was accounted by my accountant as a donation. But for tax people, all the donations for you will not be donations for them. For them, the donations will be only the donations made to charitable organizations. And his name was never included in the list of charitable specified charitable institutions in Inland Revenue Act. So now what they did was 1 million rupee donation, which is deducted already from my accounting profit calculation, was added back to my accounting profit. Why? The donations for tax purpose should be only the donations made to approved charities. And the donations I made was not a donation to an approved charity. So for tax people, it's not a donation. So then I can't deduct it from my taxable profit. So we arrive at the taxable profit by adding it back to my accounting profit. So what should be my taxable profit now? 7 million rupees. Accounting profit is 6 million. Taxable profit is 7 million. So there is a difference between the accounting and the taxable profit in the year 19. And can I expect this 1 million rupees to be deducted from next year taxable profit? You cannot. Can I expect this 1 million donation to be deducted from my taxable profit in another 5 years time? I cannot. Can I expect this 1 million donation to be deducted from my taxable profit in another 10 years time? Cannot. Can I expect this 1 million to be deducted from my taxable profit even after my death as a businessman? No. So that 1 million is a difference that arises during the current year and remains forever as a difference between the accounting profit and the taxable profit, and that is a never reversing difference. So that difference that never reverses in the future is a permanent difference between the accounting profit and the taxable profit, guys. Remember, it's not like the previous example where we took interest income. Here the donation is under which category? This is under permanent difference category. We will calculate deferred taxes because accounting profit and the taxable profits are different from each other. These differences are taken into two broad categories. Basically, what are these two categories? Temporary and permanent. For the God's sake, please remember, we calculate and recognize deferred taxes only on temporary, not on permanent. Why? I will not explain the philosophy and the reasons right now. Let me just leave it aside for the time being. Just in a while we can discuss that. So I think the things must be clear. You need to work out two taxes now in our calculations. First is the current, which is on the taxable profit, and the deferred tax has to be the second, which is on the differences between the accounting profit and the taxable profit. So, let me first take you through the calculations of deferred taxes. We will do as many calculations as possible to get familiarized with this concept of deferred taxes, and then we will also take current taxes. And here let me now explain how deferred taxes are calculated. Very interesting area, and you need to keep listening. Now, accounting profit 5 million rupees, and we have property, plant and equipment at a cost of 4 million. This is depreciated for accounting purpose at 25%. and for tax purposes at 50%. This profit is already after accounting depreciations of 1 million rupees, and taxable profit should be now calculated 5 million. Add accounting depreciations of 1 million rupees back and deduct tax depreciations of 2 million. So, this is 4 million into 20%, current tax should be 800,000. The difference between the accounting profit and the taxable profit is 1 million, and that difference into 1 million into 20% tax rate 200,000. So, let me bring current tax here 800,000, which is on the taxable profit, and deferred tax figure should be 200,000, which is on the difference between the accounting profit and the taxable profit, right. Now, ladies and gentlemen, first and foremost, before you initiate the deferred tax calculation, you need to have the difference between the accounting profit and the taxable profit. Remember, the standard LKAS 12 never encourages you to calculate deferred taxes by comparing the accounting profit and the taxable profit. That is not the approach which LKAS 12 prescribes. You cannot calculate the difference between the accounting and the taxable profit by comparing these two profits, and we have a different approach. What is a different approach? Let me give it to you right now, and we will start explaining gradually bit by bit. How do we calculate the difference between the accounting profit and the taxable profit the way LKAS 12 prescribes? You will take the accounting written down value of an asset or a liability from which we are deducting tax base of the asset or the liability, asset to the liability. Wow! And you will think for yourself, what the hell is this? We have not done this before. And if you do it for the first time, how can we take the difference between the accounting profit and the taxable profit by having this rigmarole, accounting written down value of an asset or a liability minus the tax base of the asset or the liability? It is like this. Now, you need to keep listening. I am going to tell you a story. What is it? For financial accounting purpose, we know the procedure and the protocol, so you have studied that from your A level. We have the source document from which the transactions are extracted, they are taken to prime entry books and then they are taken to general ledger, then we will extract the trial balance and there will be couple of adjustments and then we prepare the financial statements at the end of the period. So, that is how it flows through from the beginning to the end, and that is the procedure. Now, you maintain a ledger where the transactions are recorded and entered, and that is completely based on SLFRSs. And please, ladies and gentlemen, we will do another imaginary exercise, hypothetical exercise. What is it? As much as you maintain a ledger for accounting purposes, as long as you maintain, you maintain a ledger where the accounts are updated based on the requirements of SLFRSs, you also maintain another ledger to re-account the same set of transactions on the basis of the existing tax law. It never happens practically, but I want you to assume so. So, we maintain two sets of ledgers, one is for accounting purpose, the other one is for tax purpose. End of the first ledger, you prepare the trial balance and then you prepare the profit and loss for accounting purpose and the balance sheet. End of the second ledger, where the same transactions were re-accounted based on tax law, you then prepare a balance sheet and a profit and loss where from which you determine taxable profit, not the accounting profit. I hope it was clear. Let me take a simple example just to illustrate. The second exercise is completely hypothetical, imaginary, it is completely a fantasy. It never happens practically, but it is alright, this is for our learning purpose. Now, property, plant and equipment. We purchase them at 4 million rupee. This is in financial accounting purpose ledger. And you depreciated it by 1 million rupees, you credited asset by 1 million rupees and debited profit and loss by 1 million rupees. So, property, plant and equipment will be shown in the balance sheet for financial accounting purpose at 3 million rupees. 3 million rupees. And the second ledger we imagined, visualized. We open up the property, plant and equipment account, to which you will debit 4 million rupees, and these guys, tax people, depreciate the asset not for accounting but for tax purposes. At 2 million rupees, you credit the asset by 2 million rupees and debit to profit and loss by 2 million rupees. Now, if you prepare a balance sheet for tax purposes, after at the end of this exercise, end of this ledger, you prepare a trial balance, then you prepare the profit and loss for tax purpose and the balance sheet for tax purpose. In that balance sheet prepared for tax purposes, property, plant and equipment will be shown at how much? 2 million rupees. See, accounting depreciation was 1 million rupees and tax depreciation was 2 million rupees. Accounting profit got deducted by only 1 million rupees and taxable profit was deducted by 2 million rupees. We will forget about the other differences. The accounting profit and the taxable profit will be different only by how much? 1 million rupees. And that difference can be simply determined by comparing the value of property, plant and equipment that appears in the balance sheet for accounting purpose and the value of the same assets that appears in the balance sheet for tax purposes. Here, the balance of property, plant and equipment that appears in the accounting balance sheet is 3 million rupees. Here the balance of property, plant and equipment that appears in the tax balance sheet is 2 million rupees. Take the difference, and that difference 1 million rupees is exactly equal to the difference between the accounting profit and the taxable profit. So then hereafter, whenever you want to calculate the difference between the accounting profit and the taxable profit, please, you need not to look at the accounting profit and loss. Neither do we ever look at tax profit and loss or tax calculations. Instead, we need to look at the accounting balance sheet prepared for accounting purpose and the second balance sheet that was prepared for tax purposes. Remember, never find tax balance sheets in your working place, in your client places. You will never find it practically. This is just a hypothetical, completely a fantasy. It has to be visualized in your mind, and you need to have accounting balance sheet on your right hand and the tax balance sheet on your other right hand, and compare those two and then find the differences. Those differences will be exactly equal to the total difference between the accounting profit and the taxable profit. I hope it was clear, and this is the bread and butter in our discussions, be all and end all in our discussions. If you miss this part, that is like you fail in the whole exam. So you need to get this right properly. If you do not get this right, you will never get the standard right. Now, you can remember the formula I said. To calculate the difference between the accounting profit and the taxable profit, what do? You take the accounting written down value of an asset or a liability minus tax base of the asset or the liability. What is accounting written down value? Very simple. Accounting written down value has to be the value of an asset or a liability that appears in the accounting balance sheet. It is not the technical definitions, just keep it aside for the moment and let us see what is easier. This is the easier method. Accounting written down value of an asset or a liability has to be the value of an asset or a liability that appears in the accounting balance sheet. Tax base of an asset or a liability has to be the value of an asset or a liability that appears in your visualized and imagined tax balance sheet. So as a result, it is just a matter of comparing the accounting balance sheet with imagined visualized tax balance sheet and see the differences. Those differences will be exactly equal to the difference between the accounting profit and the taxable profit. For any questions, for any item, whenever you want to determine the tax base, please you need to think as to what the value of that asset or liability that appears in the tax balance sheet based on the underlying tax law, based on the relevant tax law. Now, however much I repeat the same thing over and over again, that is of no use. I will take you through a couple of examples, illustrations profusely, and then you will get it right. So here we go. We will go to a simple example, and we have a bit of a lengthy illustrations. Let me take a couple of items from the question number 1, and let us see how we determine tax bases first, and then the differences between the two profits, and then the deferred taxes. Question number 1, you are required to determine tax bases And to calculate deferred taxes at each of the following instances, you are required to assume a corporate tax rate of 20%. Cost of inventories is 600,000 and net realizable value is 520. Tax law does not permit the inventories to be written down from cost to NRV. This is financial accounting. And this is tax accounting. And you know we maintain two ledgers now. This is based on tax law, this is based on SLFRSs. Inventories would have been recognized to books first at cost 600,000. So would have been tax people, inventories are 600,000, right. LKAS 2 requires inventories to be measured at the lower of cost and NRV. What is cost? 600,000, what is NRV? 520. So you need to write down inventories from cost to lower NRV by deducting 80,000 from inventories, credit inventories by 80,000 rupees and debit to profit and loss by 80,000. So the balance of inventories to appear in the accounting balance sheet should be 520,000, 520. And tax law does not require that to be done. Never does tax law require the inventories be written down from cost to NRV, that there is no requirement as such in tax law. So there is no correspondent credit to inventories and debit to tax profit and loss, and inventories continue to be at 600,000 rupees in tax accounting. If you prepare the accounting balance sheet, what has to be the value of inventories that appears in the accounting balance sheet? 520,000, what do we call it in LKAS 12? Accounting written down value of inventories. Accounting written down value of inventories 520,000. That was picked from the accounting balance sheet. Minus tax base of inventories. So where did I say the tax base has to be picked from? Tax balance sheet. If you prepare the balance sheet for tax purposes along with the tax profit and loss where the taxable profit can be determined, the value of inventories in that tax balance sheet should be 600,000. Don't think of pluses and minuses, simply the accounting profit start being different from the taxable profit by how much? 80,000 rupees, 80,000. And if you calculate taxes on the difference between the accounting profit and the taxable profit, that is not current tax, that is the deferred taxes. Here the deferred tax figure should be 16,000, 16,000. Now listen, accounting written down value was taken from the accounting balance sheet and tax base was taken from the tax balance sheet, and the difference was 80,000 rupees. What is this difference? Temporary difference. I will explain how it becomes temporary. Temporary difference between the accounting profit and the taxable profit. See, you deducted 80,000 from the inventories and debited that to profit and loss. So the accounting profit got deducted by 80,000. Have you ever done the same exercise in taxation as well? No, you never credited inventories, never did you debit to profit and loss in taxation. So the taxable profit was not deducted by 80,000, which was the deduction from the accounting profit. So the taxable profit must be higher by 80,000 and accounting profit should be lower by 80,000 rupees than taxable profit. That simple difference of 80,000 was calculated and determined not by comparing the accounting profit and the taxable profit, but by comparing the accounting balance sheet and the tax balance sheets, and this is the approach which LKAS 12 adopts and prescribes, not the approach of comparing the accounting profit and the taxable profit. Now, it is just a matter of practicing more illustrations and examples, and to be mastery, I will take you through some more examples. The more you practice, the better. Practice makes a perfect man, and the rolling stone gathers no moss. So, you need to practice more and more. Some harder instances can be given at the exam, so you need to be ready. Second one, cost of inventories is 400,000, provision for slow moving inventories was 80,000, the provision is not permitted as per tax law, right. Let me take the accounting written down value of inventory. So, where did I explain it is taken from? Where did I say the accounting written down value should be taken from? It is from the accounting balance sheet. Cost of inventory 600,000 minus the provision, I made a mistake, it has to be 400,000, provision for the slow moving inventory 80,000. Then accounting written down value of inventories has to be 320. This was the value of inventories in the accounting balance sheet minus tax base of inventories. So, where did I explain the tax base should be taken from? It is nothing but the tax balance sheet. If you had prepared a tax balance sheet, they would have recognized inventories at 400,000 rupees, and are they creating any provisions for slow moving inventories? Not, it is not allowed in tax law, it is not allowed. So, the value of inventory is now in tax balance sheet should be 400,000, temporary difference should be 80,000 into 20% tax rate. Once again, deferred tax figure should be how much? 16,000. Then C, third one. Cost of an item of property, plant and equipment is 800,000 rupees and cumulative depreciation is 160,000 rupees and cumulative capital allowance is 320,000. Let me take accounting written down value of property, plant and equipment. That is the value of property, plant and equipment that appears in the tax accounting balance sheet rather. What is the cost? Cost is 800,000 minus cumulative depreciation of how much? 160. So, the written down value should be 640,000 minus tax base of property, plant and equipment. So, where did you learn it has to be taken from? From the tax balance sheet. Cost is 800,000 minus cumulative capital allowances, how much? Let us see the figure. Cumulative capital allowances should be 320,000. 800,000 minus 320,000, that is 480,000. 480,000. the difference between the accounting profit and the taxable profit should be 160 into 20% tax rate. Deferred tax figure has to be 32,000. 32,000 deferred tax figure. We will move on to number D. ₹1,000,000 worth of a payment was recognized as an intangible asset as per LKAS 30, and this has been expensed immediately in taxation, deducted from the taxable profit immediately. Accounting written down value of intangible assets 1,000,000. What did accounting people do? They credited cash and debited to intangible assets. So, intangible asset appears in the tax balance sheet. So, never think of the profit and loss, then you will be confusing. You will confuse yourself. Then tax people, what they did was, this 1,000,000 was credited to cash and debited to an expenditure account, not to an intangible asset. Why 1,000,000 has got deducted from the taxable profit at once? So, without it being debited to an intangible asset account in tax accounting, they have simply debited to an expenditure. So, the intangible asset with a value of ₹1,000,000 that was created in financial accounting does not get equally created in tax accounting. Why? They debited an expenditure, not an asset account. So, the value of the intangible asset that appears in the tax balance sheet should be 0. Tax base of intangible asset should be 0. So, the difference between the accounting profit and the taxable profit should be 1,000,000. So, deferred tax figure should be 200,000. How LKAS 12 or the way LKAS 12 defines tax bases can be different from the way I explain tax base. I mean, the calculations are the same, but the way they explain tax base is quite different from what I thought the tax base is. Let us look at their technical definitions in a little while. That I feel bit confusing, and I feel this method is more easier, and I do not think there is any chance of you being getting that wrong at the exam if you apply this method, and it is quite easy. Next one, E. Carrying value of an asset before revaluation was 1.2. The asset was revalued up to 1.5 million. The capital gains are taxed only on disposal. Accounting written down value of the asset after revaluation 1.5 million. 1.5. Tax people do not include capital gains. Now, you recognize capital gains from the revaluations. Tax people do not recognize capital gains into the taxable profit before the asset is sold. So, they include capital gains of the assets into the taxable profit only at the point of the asset being sold. Since the asset has still not been sold, tax people do not recognize capital gains into the taxable profit. In other words, though you revalue that in financial accounting, tax people do not. So, then tax base of the asset should be, without it being revalued, how much? It is 1,200,000. 1,000,002. Difference is 300,000 into 20%. So, deferred tax figure should be 60,000. So, the tax people, when they prepare the tax balance sheet, recognize the asset at 1.2 million. Why? they could not and they cannot revalue as per the law. They have to continue it to show it at 1.2 million rupees, not at 1.5 million rupees. So, as a result, the accounting profit, say the accounting profit and the taxable profits can be different from each other by how much? 300,000. You might say sometimes revaluation gains are not taken to profit and loss, it goes elsewhere to an equity account. We will take those matters in little while. Then next one, F. Carrying value of an investment property before the revaluation was 700,000 and this was revalued at 1 million rupees and capital gains are taxed only at disposal. A similar kind of an item, accounting written down value of investment property, it is taken from the accounting balance sheet. How much? It is at 1 million rupees after being fair valued. Tax people are not permitted to revalue and fair value. So, capital gains, whatever the gain that is arising from the revaluations cannot be included into the taxable profit unless you sell it. You can include capital gains into the taxable profits only at the point of the asset being sold. So, since we haven't still sold the asset, that 300,000 cannot be added to the taxable profit. So, they do not fair value investment properties and they decide to continue to show investment properties at the same value of 700,000 minus tax base of investment properties 700,000, difference 300 into 20%, once again should be a deferred tax item, deferred tax amount of 60,000 rupees. Next one, G. A company obtained a bank loan of 500,000 rupees. The company made a request from the bank to write off the bank loan by 50% as the bank is running short of money. The loan was written off by 50% and the accounting was done accordingly. However, tax authorities are awaiting the bank's confirmations to account for the write-off. Let me do a small explanations of the accounting part of it. Bank loan 5 million and even tax authorities or tax purpose, the accounting would have been the same. Debit cash by 500,000, credit to bank loan by 500,000. And later we got into a financial mess and we are struggling in finance, we are right up to the neck and we are going to founder. And then we all of a sudden remembered the fact that we had taken the bank loan from a bank with a heart. And we wrote to the bank saying that, please dear banker, you need to practice without preaching and you need to show the fact that you have a heart by writing off our bank loan by 50%. And since we were confident that the bank with a heart will listen to our request and they will write it off by 50%, even without the bank sanctioning and approving the write-off, we in financial accounting did the accounting for the write-off by debiting bank loan by 250,000 rupees and crediting to profit and loss by 250,000. So, your accounting profit gets added by 250,000 rupees as a result of the bank loan being written off by 50%. Tax authorities say no, we will include that into the taxable profit, and the taxable profit will increase only when the bank gives their consent and the bank sanctions the write-off of the bank loan by 50%. Still, the bank has not given their consent. As a result, the tax people did not recognize that bank loan being written off by 50%. So, the bank loan continues to appear in the tax balance sheet at the same value of how much? 500,000. Now, let me put them into our same format. Accounting written down value of the bank loan. Accounting written down value of the bank loan should be 250, and where did I take it from? From the accounting balance sheet, minus tax base of the bank loan, tax base of the bank loan. Where should I take it from? It has to be from the tax balance sheet. How much should be the figure? 500,000. Difference is 250 into 20%. So, deferred tax figure should be 50,000. So, this is how you do the calculations of tax base and accounting written down value, and then deferred tax calculation. Next one, debtors are 700,000 and a provision was created for bad debts. Accounting written down value of debtors. What do you think should be the value of debtors to appear in the accounting balance sheet? It has to be the debtors balance minus the provision for bad debts. 700,000 minus 140,000, that has to be 560,000. Accounting written down value of debtors minus tax base of debtors. Tax base of debtors. Where did I say the tax base should be taken from? Tax balance sheet, and the tax law does not allow you to create provisions for bad debts, and there cannot be a deduction of 140,000 from debtors in the tax balance sheet. So, it is 700,000, no provision. So, tax base has to be 700,000 rupees. The difference is 140,000 into 20%. Deferred tax figure should be 28,000. I will just keep the next one aside for the moment, and let me move on to J. Accrued expenses are 80,000, and let me do a simple double entry accounting for that before we calculate tax basis. Accrued expenditure 80,000, you debit to expenditure by 80 and credit to accrued expenditure by 80,000. So, this is the value of services consumed and due for payment, and the payments are not yet done. So, you recognize this on accrued basis. What does tax law say? Accrued expenses are 80,000 rupees. This particular expense is taken for tax as an allowable expenditure only on cash basis. this particular item can only be deducted from the taxable profit only when you pay that in cash. Have you paid that in cash? Not at all. We haven't. It's still due for payment. And you might pay that in cash in the next year. You cannot ignore that from your expenditure, though, just on the fact of not having been paid in cash. Now, tax people do not deduct it from the taxable profit. Why? This particular item becomes a deductible item, deductible expenditure from the taxable profit only if you pay that and settle that in cash. So, can they credit to accrued expenditure? Cannot. Can they debit to taxable profit? Cannot. Then take the accounting written down value of accrued expenditure. How much? 80,000. Minus tax base of accrued expenditure. Tax base of accrued expenditure, how much? Should be 0. So, the accounting profit and the taxable profit are different from each other by 80,000 into 20% tax rate. Deferred tax figure should be 16,000. That is quite obvious. Even if you apply the other method, which is not recommended by LKAS 12, let me explain just for a small assurance that what we did was absolutely correct. Now, this 80,000 you debited profit and loss and credited to accrued expenditure. So, the accounting profit was deducted by 80,000, that became lower by 80,000, whereas tax people never deducted 80,000. So, taxable profit is bigger by 80,000 rupees than accounting profit, and accounting profit is smaller by 80,000 rupees than the taxable profit. So, the deferred tax figure should be 16,000. Next one, a building was constructed with a total cost of 1.5 million. $1,500,000. The construction was fully financed by a bank loan and interest for the loan was 300,000. Interest was capitalized to the building as per LKAS 23, however, this was expensed immediately in tax law. The cost of the building is 1.5. How did you raise finance the construction of the building? That is from a bank loan of 1.5, for which we were to pay interest of how much? Interest was 300,000. That 300,000 interest component can be added to the cost of the building itself under LKAS 23. So, the value of the building to appear in the accounting balance sheet should be 1.8 million rupees. Included in this cost of building of 1.8 million rupees is the interest component of the loan as well. Accounting written down value of the building is 1.8 million rupees. Tax people have a different practice. They credited cash and debited building by 1.5. So, what about the interest component? Tax law does not allow that interest to be added to the cost of the building, but to be deducted it from the taxable profit of the year. So, 300,000 instead of being debited to the building account has been debited to the tax profit and loss. So, what should be the value of the building to appear in the tax balance sheet? Now, minus tax base of the building. Tax base of the building should be 1.5. So, the difference should be 300,000 into 20%. Deferred tax figure should be 60,000. We are moving on to L. A provision for retirement benefit was created for 80,000 rupees. Provision for retirement benefit is not allowed for taxation. Accounting written down value of retirement benefits $80,000. 80. You just bring that to a liability. You need to learn LKAS 19 to get it right, and you would have debited that to profit and loss and credited to the provision or liability. And this provision is not allowed in taxation. What you can deduct from the taxable profit is not the provision but the actual benefit payments in cash. So, the question does not talk about actual settlements of benefit in cash, and tax people would not have recognized the provision, the same provisions as you recognize in financial accounting. No credit to a provision in tax accounting and no debit to tax profit and loss. What does it say? The provision of retirement benefit that appears in the accounting balance sheet, the balance of the provision that appears in the accounting balance sheet does not equally appear in the tax balance sheet, does not appear. Tax base of retirement benefits should be 0. Difference is 80,000 into 20%, deferred tax should be 16,000. 16,000. Next one is something similar to the previous one. A provision was created for warranty sales at 60,000 rupees and this provision is not allowed for taxation. The same story. Accounting written down value of warranty provision $60,000 minus tax base of warranty provision, tax base should be 0, difference is 60,000 into 20%, deferred tax figure should be 12,000. Next one, N. 150,000 was received as a sales advance. This income is recognized for taxations on cash basis. Simple double entry accounting explanation. 150,000 advance payment for a sale to be done maybe next year. You, without it being recognized into revenue, should recognize that into a liability. Why? We are under the obligation to deliver goods for a value of 150,000 rupees. And as you transfer the goods to the customer, then you can de-recognize sales advance liability and you can recognize revenue later as the goods are delivered. Until such time you deliver the goods, you need to bring it to a liability account. Sales advance is a liability. So, where do we show the liabilities? In the financial statements, in the statement of the financial position. So, what do tax people do? They recognize this particular revenue into taxable profit on cash basis. So, do not get, I mean, you will have to take it right without taking the wrong end of the stick. It becomes a revenue for tax people only when you receive that in cash, irrespective of whether the goods were delivered or not. Indiscriminately, tax people add it to the taxable profit as an income only when you receive the cash amount, ignoring the fact whether the goods were delivered to the customer or not. Maybe you would have delivered the goods to the customer 10 years back and we haven't still received the amount. It is not added to revenue. Maybe you received the amount of cash right now and the goods are yet to be delivered in another 5 years time. Now, we add it to taxable profit right now. What matters is here is the receipt of cash. It is not, I mean, what matters is not whether the goods were delivered or not. So, then tax people debit it to cash account by 150,000, credit where? Credit to revenue by 150,000. Tax people credit that to a revenue account, not to a liability account. This does not appear in the tax balance sheet, revenue. What do we talk about? We talk about sales advance. What is the value of the sales advance that appears in the accounting balance sheet? 150,000. Accounting written down value of sales advance 150,000 minus tax base of sales advance. So, the sales advance liability that you recognized in financial accounting does not appear in the tax balance sheet and that should be 0. Temporary difference 115 to 20% should be 30,000 deferred tax. Last one, bit of a tricky one, you need to keep concentrating, do not let your mind to stray. A company obtained a bank loan of 600,000 rupees and this does not have any tax consequences. The accounting written down value and the tax bases are considered to be equal where an item is not considered to have any tax consequences, and you can remember it if you want, or else I can explain the logic. And let me take the last item together with the one before the last one. Sales advances and the bank loan. 150,000 sales advance. In financial accounting, it was recognized to sales advance liability and this goes to balance sheet eventually 150,000. Tax people, what they did was, without it being recognized into a liability, they recognized that into revenue 150. The way this sales advance item is treated in financial accounting is different to the way it is treated in tax accounting. As a result, there is a tax consequence. In other words, as a result of the way of treating this in financial accounting being different from the way in which it is treated in taxation, that will create and that will result in accounting profit from being different from the taxable profit. And if the question says that a particular item has a tax consequence, what it tries to imply you is the fact that this item will result in the accounting profit and the taxable profit in being different from each other. And if the item is said to have no tax consequences, what does it say? It does not result in the accounting profit and the taxable profit from being different from each other. It does not result in the accounting profit and the taxable profit in being different from each other, and in other words, the way it is recognized in financial accounting should be similar to the way it is recognized in tax accounting. How do we recognize the bank loan in financial accounting? You simply debit to cash and credit to bank loan. $600,000. Since it does not have tax consequences, the way it is recognized in tax accounting should be exactly equal to the way it is recognized in financial accounting. So, then in tax accounting as well, you debit cash and credit to bank loan by 600,000. Debit cash and credit to bank loan by 600,000. What is the accounting written down value of bank loan? 600,000 minus tax base of the bank loan, again 600,000. This was taken from the tax balance sheet. So, the difference is 0. It is quite obvious why. The accounting for the bank loan in financial accounting is absolutely similar to the accounting of the bank loan in tax accounting. So, that cannot result in the two profits in being different from each other, and here in other words, accounting written down value and the tax basis should be equal to each other. So, that being equal to each other means indicates the fact that accounting profit and the taxable profits are equal. Now, just in a small nutshell, if you just recap all what you learnt from the beginning to right up to now, I said you need to discuss two taxes in LKAS 12, current tax and deferred taxes. So, what did I explain the current taxes were? Current taxes are the taxes to be paid or to be received based on the taxable profit. So, what did you learn the deferred taxes were? Deferred taxes are the taxes that are calculated on the differences between the accounting and the taxable profits. And are we recognizing deferred taxes on all the differences between the accounting and the taxable profits? No. So, what are the differences on which we only recognize deferred taxes? That is the temporary and not the permanent. And then you learned how the differences are calculated by adopting the approach of LKAS 12. You need to compare the tax base along with accounting written down value, and that is what we have been discussing up to now in LKAS 12. So, we can proceed. So, the difference, which is the caption matter, which result in you recognizing deferred taxes, were broadly taken into two, and they were temporary and permanent. differences were taken into two, basically temporary and permanent. And this is what we started talking about initially. Temporary differences are further taken into two: taxable temporary differences deductible temporary differences. And even this part is equally important. From taxable temporary differences, we recognize deferred tax liabilities. And from deductible temporary differences, we recognize deferred tax assets. Deferred tax assets. And in the previous exercise, we did lot of deferred tax calculations on various temporary differences, and some of the differences we worked in example number 1 should be under this first category of taxable temporary differences, and some of the differences should be deductible in the second category. And how do we distinguish? How do we differentiate them from each other? And that has to be the topic now. You need to learn this right in detail to work out the questions at the exam, and you need to keep listening. I am going to tell you how temporary differences will be now grouped into two. First is taxable temporary differences, second deductible temporary differences. I will tell you how it is done, and this part is equally important. So, let me get back to question number 1 part A. Accounting written down value of inventories 520,000 minus tax base of inventories 600,000. Temporary difference was 80,000 into 20%, the deferred taxes we recognize was 16,000. Now, this 16,000 deferred tax figure can be sometimes a deferred tax liability, or it can be a deferred tax asset. That is depending on whether the temporary difference on which you recognize deferred taxes is a deductible difference or a taxable difference. How do we know it? Now, inventories were originally recognized into the books at 600,000 rupees, and so did the tax people, 600,000. And we realized the fact that you cannot sell the inventories at the price you purchased them at. Now, the inventory selling prices must be at dog cheap prices like 520. So, you credited inventories by 80,000, debited to profit and loss by 80,000. So, that the balance of inventories became 520,000. By being prudent in financial accounting, the possible loss that will be materialized at the point of the inventories being sold has already been recognized into the profit and loss even without, well before the inventories were sold. So, the accounting profit has been deducted by 80,000 rupees, and we will get on with tax now. Tax people did not do that, but can the tax people sell the inventories at 600,000 rupees? No. What seems to be the possible selling price at which the inventories can be sold in the future? 520. And they sell inventories at 520,000 in the future, and then they will recognize that loss of 80,000 only at the point of the inventories being sold. In financial accounting, you recognize that possible loss well in advance even before the inventories were sold. Tax people will spot and recognize that loss of 80,000 rupees only at the point of the inventories being sold. We recognize it right now immediately being finance people, and tax people recognize it only when the inventories were sold. So, the difference between the accounting profit and the taxable profit that arises as a result of inventories being written down from cost to NRV will reverse in the future as inventories will be sold in the future at this lower price of 520. So, this difference is what? A temporary difference, and this profit of accounting and taxable will remain different from each other only until the inventories will be sold. Right. You have deducted 80,000 from the accounting profit right now, but we have not deducted 80,000 from the taxable profit right now, and we have paid taxes on a higher taxable profit because we haven't deducted 80,000. And we are awaiting to deduct that 80,000 loss from the future taxable profit. And this 80,000 difference between the accounting profit and the taxable profit is to be deducted from the future taxable profit or to be added to the future taxable profit. This 80,000 difference is to be deducted from the future taxable profit, to be deducted from the future taxable profit. If it is to be deducted from the future taxable profit, this 80,000 difference will result in a future tax saving or in a future tax payment that will result in a future tax saving. So, that has to be an asset. So, that is how you identify deductible differences. As the name given suggests, it is to be a future deduction from the future taxable profit. And let me take another example to explain taxable temporary difference. So, we had investment properties in one of the items, that is item F. Investment properties were at 700,000, it was fair valued to 1 million rupees and you debited 300,000 to investment properties. So, the balance of investment properties became 1 million. Tax people did not do that. Tax people continued to show investment properties at 700,000 rupees. Accounting written down value of investment properties was 1 million and tax base was 700,000. Tax base was 700,000. Now, this difference between accounting profit and the taxable profit of 300,000 should be a taxable difference. How did you do that? How did you realize it? How did you understand it? Let me explain. This investment properties at 700,000 were fair valued to 1 million rupees by recognizing this capital gain of 300,000 rupees to accounting profit even without the investment properties being sold. So, you have a potential profit, possible profit of 300,000 if you sell investment properties at 1 million rupees in the market. So, you included that into the accounting profit even without investment properties being sold. Have you included the same profit to taxable profit? You have not. You are awaiting to include that profit of 300,000 rupees to future taxable profit at the time of the investment property being sold in the future. At the time and the point of the property being sold in the future, this 300,000 is to be added to the taxable profit or is to get deducted from the future taxable profit, is to be added to the future taxable profit. If it is to be added to the future taxable profit, your taxes in the future will be more or the taxes in the future will be less, that will be more. So, this will result in a future tax payment or a future tax saving that will result in a future tax payment. So, this 300,000 is future tax deductible or future taxable. It is future taxable. If it is future taxable, as the name suggests, that will result in you having a future tax payment. So, that will result in a deferred tax liability of, we recognize 60,000. So, that is under taxable difference and you will recognize a deferred tax liability from taxable temporary difference. And you cannot do this at the exam. It takes long time and sometimes certain items are so tricky, and when you do it in your mind, sometimes you will do some mistakes. So, I will give you another shortcut. Remember, whenever you apply shortcuts, there can be short circuits. You should understand it. And I will give you some shortcut methods. Remember, shortcuts are not the best always and you need to understand it genuinely. But let me give you a simple method to identify temporary differences into taxable differences or deductible differences. just a small table. Just a matter of reading the table and then we get the solutions for anything. Tax base of an asset is higher than the accounting written down value. The result in deferred tax figure should be a deferred tax asset. Where the tax base of an asset is lower than the accounting written down value, the result in deferred tax figure should be a deferred tax liability. Where the tax base of a liability is higher than the accounting written down value, the result in deferred tax figure should be a deferred tax liability. Where the tax base of a liability is lower than the accounting written down value, the result in deferred tax figure should be a deferred tax asset. And you need to remember it, and we have some other methods if you want, if you prefer, kind of an thinking exercise without just by hearting and remembering it. You can also think, let your mind to work fast and you can get the answers. That is also possible, but I will give you this method, just a matter of remembering, and then you can decide what and what should be taxable, what and what should be deductible, and taxable will result in deferred tax liabilities and deductible will result in deferred tax assets. Let's practice the exercise. Question number 1, and inventories, first one. Accounting written down value 520, tax base 600,000. So, what do we talk about? We talk about accounting written down values and tax bases of inventories. This is what is important in inventory. Inventory is an asset or a liability, inventory is an asset. Accounting written down value is 520, which is lower, and tax base is 600,000, which is higher. Where the tax base of an asset is higher, you need to read the table and see where we are. Where the tax base of an asset is higher, the result in deferred tax figure should be a deferred tax asset. So, the first item has given us a deferred tax figure of 16,000 rupees as far as I can remember, and the 16,000 deferred tax item should be a deferred tax asset. This is the logic, or this is not a logic, I mean you need to by heart it. If you want to know the logic, we can still explain, no issue. Second one, once again inventories. Accounting written down value of inventories in the second one 320,000, whereas the tax base of inventory should be 400,000. So, temporary difference was 80,000. Still what are we talking about? Inventories. Inventories are an asset where the tax base of the asset inventory asset is higher, tax base of the inventory asset is higher than the accounting written down value. Still this is where we are. Then again we recognize deferred tax asset. So, the deferred tax you recognize that part B should be a deferred tax asset. The deferred taxes you recognize that part B should be a deferred tax asset, Then C, cost of an item of property, plant and equipment 800,000, minus cumulative depreciation 160, accounting written down value should be 640,000. Tax base 800,000 minus cumulative capital allowances 320, tax base should be 480,000. Temporary difference was 160,000. And you recognize deferred taxes 32, and that was a deferred tax asset or a liability. Let us see now. Property, plant and equipment are assets. The tax base of the asset, property, plant and equipment is lower than the accounting written down value. So, let us read the table. Where the tax base of an asset is lower, so this is where we are now, where tax base of an asset is lower, the deferred taxes you should recognize should be a deferred tax liability. So, this 32,000 worth of deferred tax liabilities you recognized at part C has to be a deferred tax liability, and that temporary difference has to be a taxable temporary difference, has to be a taxable temporary. Why? The temporary differences that will result in you recognize in deferred tax liability should be taxable temporary differences. Fourth one, 1 million rupees worth of a payment was recognized as an intangible asset as per LKAS 38, and this has been expensed immediately in taxation. Accounting written down value of intangible asset 1 million minus tax base of intangible asset is 0. Temporary difference was 1 million into 20%, deferred tax figure was 200,000. And this 200,000 deferred tax is a deferred tax asset or a deferred tax liability. Let us look at it. So, what do we talk about? Intangibles, asset. Assets, what is the tax base? 0, that is lower than the accounting written down value. Where the tax base of an asset is lower than the accounting written down value, the result in deferred tax figure should be a deferred tax liability, and the temporary difference that creates that deferred tax has to be a taxable temporary difference, taxable temporary difference. So, we will move on to next one, E. Carrying value of an asset before revaluation is 1.2 million. Asset 1.2, and it was revalued to 1.5 million rupees by debiting asset by 300,000, crediting wherever it has to be credited to. So, the asset value became 1.5 million rupees after being revalued 1.5, and so that is not allowed to be revalued in taxation. Why? They recognize capital capital gains only at the point of disposal. So, the accounting written down value of the asset is 1.5 and the tax base has to be 1.2 million. Tax base is 1.2, accounting written down value should be 1.5. We talk about assets revaluations, we talk about assets basically. Tax base is 1.2, where the tax base of an asset is lower the result in deferred tax figure should be a deferred tax liability, and the underlying difference has to be a taxable temporary difference, taxable temporary difference, because we recognize what a deferred tax liability. Investment property is the same story, just leave it aside. Bank loan, was 500,000 and it was written off by 250, credited profit and loss and debited to bank loan. And the balance of the bank loan became 250,000 rupees after being written off by 50%. Tax people did not do that. Tax people did not do that. So, the bank loan balance continues to be at 500,000 rupees. Why? Tax people did not write it off. Balance of the bank loan is 500,000 rupees. What do we talk about? The bank loans. The bank loans are liabilities. Accounting written down value of the bank loan is 250,000 minus tax base of the bank loan is 500,000. Tax base is higher than the accounting written down value. Let us read the chart. Where the tax base of a liability is higher than the accounting written down value, the result in deferred tax figure should be a deferred tax liability, and the underlying difference, temporary difference, has to be a taxable temporary difference. It has to be taxable temporary difference. Why? It's creating a deferred tax liability. Accounting written down value of debtors. Debtors were 700,000 minus provision for bad, it's 140. Accounting written down value should be 560,000 minus tax base of debtors. Tax base was 700,000. Difference was 140 and we recognize deferred taxes at 20%, which is 28,000. 28,000 deferred tax is a deferred tax asset or a deferred tax liability. We will discuss. Debtors are assets. Debtors are assets. Accounting written down value is 560. Tax base is 700,000. Where the tax base of an asset is higher, the result in deferred tax figure should be a deferred tax asset, and the underlying temporary difference has to be a deductible temporary difference, a deductible temporary difference. We did not discuss I, and let me move on to J. Accrued expenditure was credited by 80,000 by debiting to profit and loss. Tax people did not do that because that particular expenditure item is deducted from taxations only on cash basis. So, the accounting written down value of accrued expenditure was 80,000 and tax base was 0. Accrued expenditure is a payable expenditure, that is more or less a liability. Tax base of that liability is 0 see here, the tax base of a liability is lower. Where the tax base of a liability is lower, the result in deferred tax figure should be a deferred tax asset. Next one, K. A building was constructed with a total cost of 1.5. So, let me straight away take the accounting written down value of buildings, 1.8 million. Tax base of buildings, 1.5 million. Difference was 300. What are we talking about? Buildings. Tax base is lower. We will read the chart and the table. Where the tax base of an asset is lower, tax base is 1.5. Where the tax base of an asset is lower, the result in deferred tax figure is a deferred tax liability, and the underlying difference has to be a temporary, and it has to be taxable temporary difference, that into the tax rate. Deferred tax figure would have been 60,000. This is taxable temporary difference. Next one, provision for retirement benefits. Provision for retirement benefits, accounting written down value is 80,000. Tax base was 0. So, difference is 80,000. Provision for retirement benefits of 80,000 is more or less a liability. Tax base of the liability is lower than the accounting written down value. Well, let us read the chart once again to see where we are. Where the tax base of a liability is lower than the accounting written down value, the result in deferred tax figure should be a deferred tax asset, and the underlying temporary difference has to be a deductible temporary difference. It has to be a deductible difference, and we recognize a deferred tax amount of 16,000. It was a deferred tax amount of 16,000. Then sales advances. Accounting written down value of sales advances 150,000 minus tax base of sales advances was 0. Temporary difference was 115 to 20%, deferred tax figure was 30,000. So, what are we talking about? We are talking about sales advances, which is a liability. What is the tax base? Tax base is 0. Where the tax base of a liability is lower, so this is where we are, the result in deferred tax figure should be a deferred tax asset. So, this 30,000 is a deferred tax asset, and the underlying temporary difference has to be a deductible temporary difference. Why? It is resulting in recognizing a deferred tax assets, and that is how you distinguish taxable differences from deductible differences, and at the same time this is how you identify what will result in we recognizing deferred tax assets and deferred tax liabilities, and we will continue with the balance part.